Hey, I hope you're having a good day. I'm heading over to the headquarters right now, and I want to give you a quick message on how to make money when the market is down. Okay, during a recession, during a period where a stock market might be down, housing might be down. How do you actually profit during that time? So I'm going to hit you with that today. Now, the subject and the topic we're going over is what's called an inversely correlating asset. So as you guys know, we've talked about, for the last week or so, there's correlating assets, there are non-correlating assets, and there are also inversely correlating assets. And for the example on this, I want to go back to 2008. I think it seems fitting because we're heading for another recession now, and it's important to remind ourselves how people lost money in 2008 and how people made money in 2008. Because not everyone lost money. You just hear about the people that lost money on the news because the news is trying to sell you more news, right? So I was thinking about this the other day, and if you think about 2008, in a nutshell, that was broke people getting mortgages they couldn't afford from banks that didn't have money, that sold those mortgages to Wall Street, who sold those mortgages to mutual funds, who sold those mortgages to you, the consumer, or the investor, right? That's kind of in a nutshell what happened. When the broke people that couldn't pay their mortgages did stop paying their mortgages, there was no money to go to the bank, which means there was no money to go to these Wall Street firms, which means the consumer and these corporations, they ended up getting burned on the bad debt. And that's how people lost money. They were investing in correlating assets. I want you to realize when you put money in the market and the market goes down, you will lose money 100% of the time. When you put money in your home equity and your home goes down in value, you will lose money 100% of the time. Now, there was another group of people that actually made billions of dollars in 2008, and if you watched The Big Short, you'll know what I'm talking about. But these guys, they actually looked at, all right, well, logic says when you give broke people free money and make it super cheap, and then they can't pay the bill anymore, they're going to default, and then bad stuff will happen. So what they did is they bought what's called a credit default swap. They bought insurance against these debts. And so when the borrowers defaulted and the notes could no longer be paid, the insurance paid out a benefit to the person that owned it. Now you're sitting here thinking, oh, insurance, that's a scam, that sounds boring. But it's not boring when you make billions of dollars. And that's exactly what they did. So that's called an inversely correlating asset. An inversely correlating asset means when the market goes up, you probably go down, and when the market goes down, you probably go up. And the importance of investing in a non-correlating asset is during a recession. Okay, during a time when the market does go down, you can multiply your wealth and sell it at the top while everything else is crashing and on sale. And then you can use the money from those sales, from those profits, to then go buy these assets that are on sale. And that's huge. Like, that is a big piece of leverage for you as an investor. All right, now a few characteristics of non-correlating assets. And I'm going to use, inversely correlating assets. I'm going to use gold and silver as the example here so that you guys can kind of think with one of the asset classes. So gold and silver are inversely correlating. When the market does well, gold and silver typically don't. Okay, they're very cheap. When the market does poorly, gold and silver typically skyrocket and realize a very high value. So that's an inversely correlating asset. Now, a few characteristics. When you are in a boom, an inversely correlating asset is going to look like it's not performing well. Okay, it's going to be really cheap to buy, and you've got to realize that because it's not going to be the attractive bet. It's not going to be the thing that you talk about at the water cooler with your coworkers, telling them how you're buying all this, gold and silver. Like they're going to look at you like you get tinfoil on your head, right? It's not Apple stock. It's not Amazon. It's not sexy. It literally is like stuff's going to blow up. I'm prepping and I'm going to be ready for it. And it's probably going to be quite boring until then. And you might even question while you're doing it, am I doing the right thing? Okay, so it's not going to go like up and down in price. It's pretty much going to stay at the bottom during market booms. Okay, now during a recession, here's what happens. During a recession, you're going to see it slowly start to climb, and it might dip and climb a little bit. But at a certain point, it's just like a geyser. Like the recession will be full bore, and there will be enough fear and terror in the market that gold and silver or other inversely correlating assets are going to shoot up in value. Okay, now when they shoot up in value, it's important for you to know, when am I going to sell? And you don't sell based on just pricing. You actually look at what asset am I going to try and get into with the proceeds, and I sell based on how close I am to being able to get into that asset. So if I'm looking at, all right, well, real estate historically during a recession goes down by 30%, which means if this multifamily apartment building is $1 million, it's going to go down probably to about $700,000. And so as soon as I see that my real estate pricing is down to $700,000, I would sell my gold and silver at a high and transfer that into my real estate. So that's what I'm looking at. I'm looking at what is the asset that I'm going to transfer it into. And the benefit there is you catch the upswing of the market by riding that inversely correlating wave, but you also catch the downswing of the assets you want to buy. So if you want to buy real estate, that's what you do, but you're buying real estate now at a discount because the market just crashed and values and prices are down. Okay, if you are trying to load up on stocks, which I wouldn't recommend, but if that's what you want to do, you can do that. You wouldn't be buying them at a premium. You'd be buying them, pennies on the dollar because the market just tanked. So this is called cycles investing. When you invest in cycles, it means you realize in the mid to long term, cycles always repeat themselves and they always happen. And if you're ready for them, you can make money. And that's where inversely correlating assets come in handy. So that's what I wanted to share with you today. If you're watching this, by the way, I did make a free membership site just for this topic. So if you're watching this right now and you would like to learn more about inversely correlating assets, I want you to click on the link in the comments. It's jerryfetta.com/recession. If you click on that link, it's absolutely free. It's a membership site that I built that's got about 3 hours of content in it. So you're going to have module 1. That's about an hour-long video course that you can log into and train on. Module 2 is an ebook that I wrote myself. That's going to give you a review and really help you deep dive into that information from the course. And then module 3 is going to be a summary article that breaks down the bullet points and the high points of what you need to be taking away from that content and material and what you really need to make sure you retain. Okay, so it's going to be more high level stuff. And the benefit to you is, A, it's free. You're not going to get that information free anywhere else. B, it can help you start to analyze what you've got going on for yourself. Okay, you can look at, all right, well, what kind of assets do I have right now? Am I in heavy in home equity and 401k? Because I'm probably going to crash if that happens. Or am I already in, inversely correlating assets and maybe I need to load up on some more, or maybe I need to transfer some over to non-correlating assets that don't get affected by the market. So these are all things you should be thinking about, okay? Now, another one I want to share with you guys that is inversely correlating is actually the sacred account. Really quick before I sign out here. The sacred account, if you go back, and that's what my course this Friday is going to be about, if you go back and you look at all of the depressions and recessions, the sacred account actually made money. Every single time, back since 1854. So if you think about the Civil War, the Great Depression, the 1950s recession, the 70s, the 80s, the early 90s. If you look at the 2001, 2002 tech bubble, 2008, 2011, the sacred account made money every single one of those recessions. And the worse the recession, typically the better the sacred account did. So I want you to check that out. That's something people don't usually know about or talk about. That is very interesting in my opinion. So guys, check on that link. Again, jerryfetta.com/recession. I will be signing out now. Thank you so much for watching. I appreciate you all. And please do me a favor, like, share, and subscribe. I will talk to you all soon.